In my opinion, black swan events are all just really bad risk-off market regimes. And I think this deal that we announced, the ceasefire framework that we announced last night, or not we, but the administration announced last night, it sort of removes a tremendous amount of left tail risk from the market, from the evolving distribution of probable economic and market and outcomes. And so anytime you move left tail risk from the distribution, you're talking about a mean and a median that's higher. So we got risk on pricing.
So what's the call here? I mean, I think a lot of folks were probably over the last 6 weeks kind of buffeted by all the news flow, or they could say, I have to look past this. I have to look past and focus on the fundamentals. And the fundamentals, the economy are still strong, earnings are still strong. The Fed seems to be accommodative. Is that the kind of view you have?
Yeah, well, as long as you remove that left tail risk. So if you go back to the other 5 key macro cycles, growth is in a tailwind right now. You have monetary policy in a tailwind. You have fiscal policy in a tailwind. You have liquidity in a tailwind. As long as those tailwinds persist, it's highly likely that we sustain a trend risk-on market regime.
You got a brilliant note. At the bottom of it is the most important thing. You talk up dividend compounders. Are the technology stocks dividend compounders?
Unfortunately, they won't be for the next few years as they continue to burn free cash flow.
But they can go to the bond market, and fancy guys at Yale will buy 6 times the offering.
fly by deals, absolutely, of course.
But will they be dividend? I mean, Paul talks about this.
In the future, they will be.
Yeah. It's funny because I have a conversation with the folks at Apple all the time. Like, why don't you guys pay a dividend? You could get every grandmother in the world to want to own your stock. How do you position? What's the conversations you have with your clients about positioning here? Are you taking risk? Are you pulling risk in? Are you de-risking completely? What are the conversations you're having?
Yeah, so we're systematic investors at 42 Macro. All our quantitative systems caused us to de-risk over the past 6 weeks. I believe based on this headline and the removal of the left tail risk from that distribution, it's likely that those systematic systems will start to have us regross and add exposure. And that in my opinion, is an appropriate move from a fundamental standpoint.
What would be your counsel to college endowments? They all went alternative mad. Is it safe to say, Paul?
40%.
So.
Some of these.
Some of
these guys are to blame. The Yale model.
I was going to say, RIP, Mr. Swinson. I'm a big fan of his, but yeah.
What's the counsel? To me, I'm editorializing, folks, is get back to basics. What does Darius Dale suggest to endowments out there that got too fancy for their own liking?
In our opinion, the endowments have the competitive advantage that retail investors have, which is the ability to get paid by beta. So why spend all this money chasing, fancy, alternative asset classes when you can actually just take advantage of beta and smart beta solutions and the types of solutions that we offer with our KISS model portfolio?
Give us an example of that. We got to go here in a minute, but give us one example of what you do with smart beta.
If you just add a reasonably sophisticated trend following overlay to beta, you can chop off the left tail of the distribution and leave yourself with a positively skewed return distribution, which allows you to compound returns faster.
Oh my God.